Build your dreams, live rich, and leave rich.
Welcome to Live Rich and Leave Rich. With me, Krish. You know, when I say living rich, I'm not talking about fancy cars or lavish spending. For me, it's about a feeling, a sense of peace, a life completely free from money-related anxiety. And today, we're going to tackle one of the biggest sources of that anxiety, choosing the right mutual fund. We're going to go way beyond those shiny star ratings and build a simple, powerful system to evaluate funds like a real pro, so you can finally feel calm and confident on your investment journey.
Okay, before we dive in, the usual but very important heads up, what we're talking about today is all about building your knowledge, giving you a better way to think. But your financial plan is unique to you, so please always consult with a SEBI-registered financial advisor to create a plan that's perfectly tailored to your goals.
All right, so here's the game plan for today. We're going to start by talking about something I call the rank 1 trap. From there, we'll shift our thinking to focus on consistency over just speed. Then, I'm going to give you the keys to the car, your very own 5-metric dashboard. We'll see how it works with a couple of real-world investor stories, lay out an annual health check for your portfolio, and wrap up with the core principles you need to remember. Let's get right into it. Section 1, the rank 1 trap. We need to talk about one of the biggest myths in the world of mutual funds. It's a trap that is so tempting, almost every single new investor falls for it. And today, we're going to break it down. So let's be honest for a second. When you open your favorite investing app, where do your eyes go? Come on, you know the answer. Straight to that fund with the shiny rank number 1 badge, or the one with the perfect 5-star rating. It's totally natural. We are programmed to believe that number 1 means best. But here's the thing. In investing, what was best yesterday is almost never the best tomorrow. It's a mental shortcut, a bias called recency bias. And this is the perfect way to think about it. Picking a fund just because it did great last year is exactly like driving a car while staring only at the rearview mirror. Sure, it tells you exactly where you've been, but it tells you absolutely nothing about the sharp turns, the traffic jams, or the giant potholes that are right in front of you. Today's rank 1 fund is so often tomorrow's rank 50. That's not a strategy, it's just a guess. So here's my promise. By the end of our time today, you'll have the dashboard you need to drive safely, looking forward through the windshield.
So if chasing speed is a losing game, then what's the winning strategy? Well, it all comes down to a really simple but powerful shift in how we think. We have to start valuing consistency more than anything else.
To really get this, let's use a cricket analogy. Imagine you're picking a batsman for a long test match. You've got 2 choices. First, there's player A, the gambler. He's a total wild card. He might hit a spectacular century one day, but his last 5 scores are 6, 0, 100, 2, and another 0. Wow, so much volatility. His average? A shaky 21.6. Then you've got player B, the wall. He's not flashy, he's not making headlines, but he is reliable. His last 5 scores? 40, 35, 42, 38, and 45. A rock-solid average of 40. Now, who are you picking to win the long game?
It's a no-brainer, isn't it? We'd all pick player B. And that's the big insight here. In our investing lives, we aren't looking for the fund that hits one massive 6. We're looking for the player who stays on the pitch the longest, just steadily adding runs to the board year after year after year. We're looking for consistency, not just raw speed. That is the real secret to building wealth.
So, how do we actually find these player B funds? How can we measure this consistency? Well, we need a system, a clear, unemotional dashboard with 5 simple metrics that will let you analyze any fund out there and finally feel like you're in the driver's seat.
Okay, first up, metric number 1. This is the absolute foundation, the benchmark. Think of it as the class average. It's just the performance of the overall market, like the Nifty 50. And the rule here is dead simple, non-negotiable. Your fund has to beat the average. If the Nifty gave a 12% return and your fancy, actively managed fund only gave you 10%, it failed, period. Why would you pay someone a fee to do worse than the market you could have just bought yourself?
And that leads us right into metric number 2, which is alpha. Alpha is the extra credit. It's the return the fund manager generates above the benchmark. So if the benchmark was 12% and your fund delivered 15%, that extra 3%, that's the alpha. This is the proof of the fund manager's skill. We pay them a fee for one reason, to generate positive alpha. If they aren't doing that, they aren't earning their pay.
Now for metric 3, beta. I kind of like to call this the naughtiness score.
All it does is measure how much your fund jumps around, how volatile it is, compared to the market. The market itself always has a beta of 1. If your fund's beta is more than 1, say 1.2, it's naughtier. When the market falls 10%, your fund will probably fall 12%. But if the beta is less than 1, maybe 0.8, it's more stable. It might only fall 8%. So the magic combination we're always looking for? High alpha for great returns and low beta for a smoother, less stressful ride.
Okay, metric 4 might be the most powerful tool on this whole dashboard. It's called rolling returns, and I think of it as the truth serum. See, most people look at point-to-point returns, like from Jan 1st to Dec 31st, but that can be really misleading. A fund can get lucky in one quarter and make the whole year look amazing. Rolling returns cuts through that nonsense. It calculates returns over thousands of different time periods, every possible 3-year or 5-year block. It tells you the truth. Was this fund just lucky once, or is it genuinely consistent through good times and bad?
And finally, our 5th metric, the expense ratio. This is just the ticket price. It's the annual fee you pay for the fund manager's service. Now, you might think a 0.5% difference is no big deal, but don't be fooled. Over 20 or 30 years, compounding turns that tiny fee into a huge amount of money. A 0.5% higher fee can literally cost you lakhs in lost returns over your lifetime, money that should be in your pocket. So the rule is simple. Lower is always better. And always, always choose direct plans. They cut out the middleman and are always cheaper.
Okay, theory is great, but let's see how our 5-metric dashboard actually works in the real world. Let me tell you a quick story about 2 different investors, Vikram and Anjali. So first, you have Vikram, our star chaser. He sees a small-cap fund that gave an incredible 80% return last year. That's it. That's the only number he looks at. He invests a big chunk of money, completely ignoring its really high beta, a huge red flag for risk. The next year, the market corrects. His fund plummets 40%. Vikram panics and sells at a massive loss. Now let's look at Anjali, the smart auditor. She finds a flexi-cap fund that was never rank 1, but her dashboard analysis showed its rolling returns were consistently in the top 10% of its category for 7 straight years. She also saw it had positive alpha and a low, stable beta of 0.8. When that same market crash happened, her fund went down, of course, but way less than the market. She didn't panic. She slept peacefully because she trusted her system.
Anjali's story shows you the power of having a system. So, let's turn all this knowledge into a clear, simple framework that you can use every year to give your own portfolio a health check. No more just guessing.
So, once a year and only once a year, no daily checking, I want you to run this 5-step check. 1. Open your portfolio on a site like Money Control or Value Research. 2. Check your fund against its benchmark for the last 1, 3, and 5 years. Is it winning? 3. Look at the alpha. Is it positive? You're paying for that skill. 4. Check the expense ratio. Is it under 1%? Is it a direct plan? And 5. Here's the rule. If a fund fails these checks for 2 years in a row, that's your signal. It's time to review it and maybe switch to a better performer.
We've covered a ton of ground today. We've built an entire system from the ground up. So let's just boil it all down into a few core principles that you can carry with you forever. First, don't chase stars. Ratings change all the time, but a fund's character and consistency are what really matter. Second, the benchmark is the boss. If your fund can't beat the average, just buy the average with a low-cost index fund. Third, alpha proves skill. If you're not getting any alpha, you shouldn't be paying the fees. Fourth, rolling returns reveal a fund's true character. It shows you how it acts when things are tough. And finally, review, don't react. Check your portfolio's health once a year. Stop looking at it every day.
So I'll leave you with one last question to really think about. Take an honest look at your investments. Is your portfolio built like a T20 match, based on high risk, chasing last year's hero and hoping for a bit of luck? Or is it a test match, built with skill, discipline, and consistent players, designed for steady, peaceful, long-term wealth creation? The choice is always yours.
If you found this framework useful, please do check out the Legacy Diary link in the description. And of course, if you got some value today, subscribing, liking, and sharing this with someone who needs it would mean a lot. This is Krish, reminding you to live rich and leave rich.